The Australian Tax Office has issued a warning to homeowners who've been renting out their places on sites such as Airbnb and stayz. They may get a shock when it comes to selling their property and find they're liable for capital gains tax. Here's Tony Sloan, who's a tax partner with the accounting and advisory firm BDO. Hi there, Tony. So why is capital gains tax a possible issue here?
Well, normally when you sell your home, it's tax-free. So that's the last bastion of tax concessions really that we have. But if part of your home is income producing, even for a day or a week or a month, then part of that gain can be exposed to capital gains tax. So you pay capital gains tax when you sell. So it's not now or next year, or it could be 10, 15, 20 years into the future.
How much could some people end up paying then?
Well, it's a good question. So if you rented out half your house, for example, permanently, then you would pay half your capital gain in tax. So half your house would be subject to capital gains tax, and then the capital gains tax rules would apply in that scenario.
How do you work out how much you are liable for? Because some people just rent out a room, don't they?
Yeah, well, the example that we were looking at the other day was, let's say that you go on holiday every year for a month and you decide to pay for your holiday by renting out your home. So you go, you rent out your home for a month, and you do that every year for 5 years. In that situation, you'd probably pay 1/12 of the gain. So 1/12 of the gain would be subject to the capital gains tax provisions.
And is the ATO cross-checking with these temporary stay websites when properties are sold? Are they doing that?
What's happening is the tax office is now working with Airbnb and the other hosts to basically get raw data, a bit like the banks with interest and the companies with dividends. So those organisations will be compelled to provide source data to the tax office, and they will then cross-match to rental schedules prepared by taxpayers. So mum and dads who put the tax returns in, the tax office will have instant access to data saying, yes, you've included your rent, or no, you haven't included your rent, and they'll also flag or mark your file for 20 years down the track when the home's sold, and try and collect a bit of tax on that sale.
And is renting out your home the only thing that homeowners need to be wary of? What about a home office?
A home office is okay. So there's a difference between having a home office, which is a place of convenience. So I have a place of convenience at home. I have a home office. I work there as often as I can. But that's different from a place of business. So for example, if you're a yoga teacher and you conduct a yoga business from home and you rent out, you use a floor of your home, then that would be carrying on a business. So if you're just having an office of convenience, then that won't be subject to capital gains tax. But if you have a business being carried on from home, then that would be subject to capital gains tax.
And is there any way to minimise the amount of tax you're liable to pay capital gains tax by making deductions elsewhere when you sell?
Oh, look, the key to capital gains tax, and mum and dads don't like this, but the key to capital gains tax is to keep records. You have to keep your cost-based records, you've got to keep your interest records, your land tax records. Every expense you pay in connection with your house, you basically need to keep copies of and keep them for year after year after year.
Got to be organised.
You have to be very organised.
Tony Sloan, thanks.
My pleasure. Thanks, Ros.